Okay. Okay. So we'll get back to this later. I think Gaurav's voice may not be audible, but he has started the recording. So okay, Shantanu, all yours.
Yeah,
All the best, guys.
thank you. Is my screen visible?
Yep.
Everyone's there. Yeah. Yes. Good evening, everybody. So today our team is going to be presenting on PI Industries. It's a leading player in the agrochemical space, and they have a strong presence in both domestic and export markets. Their vision is to lead with science, technology, and human ingenuity to create transformative solutions in life sciences. So let's quickly begin with a short introduction to PI. So it was established in 1947 by Mr. Piyush Singhal as Mewar Oil and General Mills Limited, which was predominantly into edible oils business. So later they diversified into other businesses such as agrochemicals, mining, energy metering, and also polymer compounding. So in 1992, the company changed its name to PI Industries Limited, and since then they are focused on CSM, custom synthesis and manufacturing, in the agrochemicals industry. Yeah, so strong global presence, and then secondly, exclusive rights that they get from global corporations are one of their key strengths. So PI Industries has a strong global presence and has established itself as a trusted partners for many global MNCs. For example, like Mitsui Chemicals or Kumai Chemicals. So the company exports its products to over 80 countries. As we saw, I think 76% of their revenues comes from exports. So this includes United States, Europe, Latin America, and Asia Pacific countries. So they focus on quality and innovation, which has helped them build long-term relations with all these big MNCs. So they also maintain strong partnerships with global innovators in the agri and pharma sectors. Their CSM business provides contract research and production services for these global MNCs innovators, helping them bring their products faster into the market and also more efficiently. Uh, Sorry, is this? I can hear some kind of ticking. Is it from my screen?
Shantanu, I can't hear anything, so I'm pretty fine. I think all of us are muted, guys. If somebody is not
You know,
muted,
I was hearing like a clock tick. That's why I got confused. I thought I
yeah,
stopped.
I can't hear anything,
Yeah, I
Shantanu.
can't hear it anymore. Sorry, I'll
Right.
continue.
No
Yeah.
worries.
So their global presence is supported by their strong infrastructure, basically. They have 5 formulation facilities and 13 multi-product plants across 4 manufacturing locations in India. Their R&D facility is situated in Udaipur, which has state-of-the-art technology and a dedicated team of over 300 scientists and chemists who work closely with the innovators. And their value chain, basically they operate across the entire agri value chain, ranging from R&D, product and development, and registration, manufacturing, marketing, and distribution. And also they also have customer connect initiatives. Like I said, they are equipped with state-of-the-art technology. So their facilities include advanced R&D labs and kilo plants, pilot plants with NABL certification. NABL is National Accreditation Board for Testing and Calibration. So the company has multi-locational manufacturing facilities, basically, including one which they incorporated in 2011 called the Jambusar plant. It's a special economic zone and it is one of the largest chemical manufacturing sites in India. In addition, they also have 3 subsidiaries. PI Japan, they focus on marketing activities in Japan specifically. Then they have PI Life Science, which focuses on CSM without the manufacturing part. And overall, they have a very strong infrastructure to kind of contribute to this entire value chain. So let's quickly talk about their value chain. I wouldn't go into detail because further Surendra will talk about it as well in depth. So if we talk about the value chain, like I said, they are present starting from R&D till market and distribution. Basically, they are into CRAMS. So they have a strong focus on R&D, and they consider it one of their key strengths. So they are aimed. So they kind of try and cater to the evolving needs of the farmers. Basically, one of the most differentiated thing that they have is their network with the farmers, which I'll go into more detail later on. So yeah, they have a strong farmer network basically, and the how their model works is they launch new products every year, basically almost every year, and that in 3 to 4 years kind of contributes to their top line growth. And this has been the pattern for the last 10 years, say. So the company has over 350 researchers, like we already talked about, and they have state of the art R&D facilities, and their CSM yeah, sorry, I forgot to, yeah. So if we talk about their CSM services, they have end-to-end solutions in the agri and pharma sectors, and they offer a wide range of services, including process development, scale up, then optimization, analytical method development, etc., etc. Also commercial production. So currently, as in at the end of Q3 of FY23, their order book of CSM stands at around $1.8 billion, and this provides them healthy revenues basically. So they cover agrochemicals, specialty chemicals, intermediates, and APIs, formulations, etc. And distribution, if we talk about, then they have a large network of over 10,000 distributors and over 100,000 retailers. So they also geotag their they have also a geotag farmer database of approximately 2.5 million farmers. This also gives them a great cross-selling opportunity when they launch new brands and products. Now, I'd like Bhavna. Now we go into management, execution, and capability. And I'd like Bhavna to take it from here.
Yes, so starting with the business value generation, the ROE and ROC have fallen over the last 10 years, as we can see from the graph. And ROE has fallen from 27% in FY14 to 13% in FY 2022. And ROCE has fallen from 35% in FY14 to 17% in FY 2022. So the main reason for this this depressing ROE and ROC numbers are the QIP proceeds which are lying idle. In FY 2020, through QIP, PI Industries raised about 20,000 million, but however, they have not used these proceeds for any low margin businesses, and they are still waiting for the right inorganic opportunity in the pharma side. Also, they have been doing some smaller projects organically. They have invested about 675 million rupees in PI Health Sciences to kickstart organic initiatives on the pharma side. Their top line and bottom line have increased owing to growth in CSM operations and other products that they have introduced in the domestic market over the years. Moving on to capital allocation and acquisition. So PI Industries is looking at 600 plus crore extra capex for the next year, in addition to the rollover capex of a couple of hundred crores in the current year. So this suggests that the company is planning to use its capital for capacity debottlenecking of existing assets and for technological solutions to support its growth trajectory. As of FY 2022 con calls, their main capex cycles and investments will not be at the pace seen in the past. And in the last 2 to 3 years, they have been through a heavy capex cycle as they created capacities in newer facilities. So it seems that PI Industries is focusing on optimizing its capital allocation by reducing capex cycles and investing in newer techniques to improve its fixed asset to revenue ratios. One acquisition by PI was that it invested 675 million into PI Health Sciences to kickstart organic initiatives on the pharma side. So they have got nearly 20% revenue from the pharma verticals in the last 4 years. So their ambition with respect to the pharma sector has been intact as of FY 2022. And another acquisition by PI in the recent years was their acquisition of Isagro Asia in FY20 for rupees 3.5 billion. It was a good buy for PI as it leveraged Isagro's distribution network and firmed up its position in the domestic market. PI was also able to derive synergies from this acquisition in CSM as well as in the domestic formulation business. And according to the Q1 FY23 con call, they are also expanding the capacity for electronic chemicals and long-term contracts in this segment. So this is a new area with huge potential. And they're also looking at building in more complex areas in the chemistry segment, like flow chemistry technology, which is getting upgraded, and innovation spends are moving up.
Yeah, so now I'll continue with the CapEx cycle and their plant capacity utilization basically. So we went through com calls and annual reports and also the VP thread for a couple of years, say the last 10 years, and we kind of found out how the company has understood cycles, how they've done their CapEx, and how it has worked out for them. So for explaining, we have taken this scenario like 2018 to 2021. Company was building capacity and they incurred major capex during this time because they saw a great impression from their customers for R&D and CSM. So major capex was attributable to CSM and R&D. And anyways, they had been adding plants since FY12, and by the end of FY19 also they had done heavy capex to add couple of more plants in addition to the Jambusar plant. So they were adding two new multi-product plants they were supposed to be commissioned in FY20, primarily for backward integration and capacity expansion for high demand products in the CSM segment. So this suggests that the company was focused on expanding its capacities in the CSM business. And this has been going on since FY 2011, you can say. And total they had spent around total capex they had planned was 900 crores for FY20 and FY21. So they expected the asset turnover ratio to be at 1.25 or to be from in a range of 1.25 to 1.75 for the new capacities, and their peak asset turnover to reach around 2 to 2.5 in 3 to 4 years from FY19. So this suggests that it would take 3 to 4 years for them to reach their peak asset turnover and utilization levels as well. So they also gave a general idea and timeline for these plants. It takes around 14 to 18 months for each plant to get commissioned, starting from zero to getting commissioned. So and as of now, most of their heavy capex cycles have been completed, and they are focusing more on moving the net fixed asset turnover ratio up basically. So if we see after doing all this, what were the results and how did this add to their revenues basically? So if we see the results, all the additional capacities that they had done capex on, had commissioned new plants, etc. They were running. They were running at almost 95% utilization as of FY20, and their CSM also revenue also registered a CAGR of 25% over FY20 to 23, and their net fixed asset turnover ratio was above 1.25 for the period as in FY18 to 21, and it stood at 2.1 for FY22. I'll just quickly show the graph. So if we see currently as of FY22, it stands at 2.1. So from FY19, 3 to 4 years, their aim was to get their asset turnover net fixed asset turnover ratio to the range of 2 to 2.5, which they have successfully done. And even during the time, they had said they'll maintain it between 1.25 to 1.75, which they have done. You can see 1.6, 1.9. So other than that, we also saw that the revenues also contributed. So to kind of understand it in more detail, so from whatever we have covered, we can say that they were successful in ramping up their business and plant capacity utilization within 2 years of new capex coming online. Other than that, if we kind of go and understand the CSM segment, so this CSM segment was when in around, say, in 2012, 2013, that's when they had kind of hit the accelerator on the CSM segment. And this was supposed to bring in a lot of operational efficiencies for them with rising revenues, and was expected to generate a great amount of cash for the company. So this was completely revolutionizing their business model. So let's see how it worked out for them. So the company undertook CapEx of 370 crores from FY11 to 13, and their revenue grew by 4x to rupees 920 crores in FY14, against 0.9x in FY11. So other than that, their average capex also from FY15 to 18, it stood at 200 crore rupees, and in FY19 it was 370 crore rupees, which however resulted in 18% CAGR growth in CSM segment revenues over those 5 years, FY15 to FY20. CSM segment, if we see, has again like witnessed a steady growth, like we said, 18% back over 5 years. And from, if we see FY11, when they kind of began working on this segment, to FY20, until when they added two new plants, there was 31% CAGR growth for all these for this period. And also their plant capacity utilization, we've already talked about. They're running at 90-95%. So they have been kind of successful at achieving near optimal levels. Other than that, there was also, other than that, as of sorry, is this not okay? Yeah, other than that, there was also this Axis Securities report, which we can refer to. So, like we said, since since they had started working on the CSM segment, they had kind of promised to keep their asset turnover ratio in the range of 1.5 to 2, which they have done. If you see the green line here, then you can kind of make out it has always been above 1.5 since FY14. And now in FY22, we saw that, however, this report is from FY20. So in FY22, we know that it is at 2.1. And their capex has also been rising since then. And CSM, like I said, the revenues have been increasing. This is from the same report as well. And they had registered 31% growth from since they began until FY20. Next, we move on to capital prudence. So if we talk about capital prudence, the company, as of FY19, they became net debt-free, and they have always been expected to fund their capex without borrowing, except I think a couple of times, 2-3 times, and they have been known to not depend on debt for funding their capex entirely. So that's mainly because they have a healthy cash flow generation. And despite the sizable capex that they undertook for adding all these additional capacities over the past few years, their capital structure and debt metrics have improved, and also their cash flow has improved. So they kind of could fund their capex or acquisitions through internal accruals. So if we see, we have kind of created a timeline to see how they funded most of their capex or acquisitions over a certain period from 2011 to 2021, from whatever data I could get. So in 2011, 125 crore capex they had basically met by internal accruals and from the proceeds of the sale of polymer business. So they sold off their polymer business to Rhodia, and the funds raised out of the sale were utilized for the new plant, which was being set for the CSM business back then. So yeah, so this capex requirement was met completely by internal accruals. Then in 2013, the company planned a capex of 100 crores, which again was completely met by internal accruals. That was the second phase of the Jambusar facility. And if we talk about 2014, their net debt came down from 180 crores to 180 crores to 85 crores, and they planned capex of rupees 150 crores, which was for the next 2 years, that is 2015 and 2016. that was also met by internal accruals. And 2019, they acquired 100% shareholding held by Isagro in Isagro Asia. So that it's a company that is basically into agro pharmaceuticals and biostimulants, which was done, I think, through their subsidiary. This was also again funded entirely, no, sorry, partially by internal accruals, and partly they had borrowed money for, they had taken debt for it. So lastly, in 2021, they acquired API and intermediate business of Inswift Laboratories Limited. So this was paid all in cash again and funded from the proceeds of the QIP. As Bhavna mentioned, there was a QIP in July 2020. So this was done partly through the funds from QIP and partly through internal accruals again. So next slide, if we see, so yeah, sorry. So yeah, so this, after seeing the timeline, we can kind of make out that the company is mostly reliant on its own cash reserves and operating cash flows to kind of fund its CapEx, and rather than taking external financing or additional debt, except a couple of times. So yeah, they generate excess cash from their operations, which they use for their internal accruals. So for that, we'll just quickly go through a few metrics that kind of help explain this better. So if we look at their CFO, cash flow from operations, we can see the trend uh, has been increasing over the years, indicating that their efficiency is improving in the operation and they are able to generate more cash flows. So it is evident that they have been consistently generating significant cash flow from their operating activities, which they can further use to fund their capex, etc. So then we look at their capex. They have been consistently investing in their growth from FY11, and and they have been expanding, adding more capacities, doing backward integration, as we've already talked about. So their capex also, we can see, has been increasing over the years. Like next, we move on to their free cash flow. This basically tells us how much of the cash that is left over after accounting for capex and then expenses, which we can see that they still have cash left after doing so much capex and incurring the other expenses as well. Other than that, if we see their cash from investing activity, we can see that they have been heavily investing in the back in the company, whatever they are earning. And FY21, if you see, it's 2,400 crores. This is because they had, I'm pretty sure this is because they had acquired Inswift Labs, the API intermediary. And yeah, other than that, if we look at their sorry, other than that, if we look at their DE ratio, they have been able to maintain a stable and also decreasing DE ratio over the period. And FY19, like I said, they were a net debt-free company, and this basically tells us that they are relying less on debt financing, and they are focused on improving their overall financial health. Also, consecutively spending money, incurring capex. And if we just simultaneously looking at the ICR, they have a very high ICR. And this is telling us that the company has a strong ability to meet their interest obligations and is in a good position basically to service all their debt, which is very low. Other than that, if you look at the CFO by EBITDA quickly, it is stable by industry standards, as in if we look at the peers quickly, UPL is at 0.68 currently, RAL is at 0.99, 0.27. So less than one. Most of the companies in this sector, their CFO by EBITDA is less than one. And especially for PI, because they have been incurring heavy capex. And so, yeah, basically it's telling us the cash generated, which is actually being converted into part of earnings. Other than that, yeah, quickly going through the walk, quickly going through the walk the talk text. So again, here I've taken a few scenarios. Yeah, again, here I've taken a few scenarios from Concalls or annual reports where they had given guidelines or given targets, had clearly mentioned, and if they have missed it or if they have met the targets to kind of see if the management is walking the talk. So if we look at FY17, yeah, in FY17, they had given a guidance of 150 to 200 BPS increase in their EBITDA margins, and they succeeded. Their EBITDA margins for FY17 stood at 24.4% as compared to 20.8% in FY16, which is, I think, which is 360 basis points increase, and their guidance was 150 to 200 BPS. Then in FY19, they again achieved their guidance of 18 to 20% revenue growth. Their year-on-year revenue growth for FY19 stood at 24.76%. And in FY20, FY20 again, they had said that they'll achieve 50 to 100 BPS increase in EBITDA margins. And they were successful again. Their EBITDA margins in FY20 stood at 21.4% as compared to 20.4% in FY19. Yeah, and then they were also commissioning 2 new plants for their CSM business as well. So this was supposed to be completed by Q3 and Q4, commissioned by Q3 and Q4 of FY20, which they had successfully done, achieving the given timeline for these plants. Other than that, in FY20, again, like we mentioned, they expected their asset turnover ratio to be in the range of 1.25 to 1.75. And their net fixed asset turnover ratio stood at 1.6. Again, they kind of met their target here. And FY21, if we see, again, they gave guidance of 20% plus top line growth in FY21. And their year-on-year revenue growth for FY21 stood at 35.96%. And this was, I think, specifically because of the seasons, Kharif season. Yeah, FY22, they achieved their guidance of 15% plus growth, and their revenue stood at year-on-year revenue growth stood at 15.79%. One quick mention from one of the interviews that I found from Mr. Rajneesh Sarna, that is, he's basically the managing director. So he had given an interview in FY13 to ET now, in which he said that they expected to improve their margins during that year. And they wanted to get expected to grow close to 1,500 crore revenue. So, and also 10 to 10.5% net profit by the end of FY13. And they were successful at achieving, I'd say, overachieving this. In FY14, their revenue was at 1,595.5 crore and PAT margin at 11.8%. Now let's talk about some of the targets that they had missed. So one thing was now FY11. This is something I read on Value because actually the company has only data available until FY17. Somehow they've deleted all the content before that. So on their site or anywhere else, you'll only find content till FY17. So FY11 mein their Jambusa plant, CSM plant, the first phase of it, they were supposed to commission it. So what happened here was there was a delay in the commissioning. It was first scheduled for Q3 of FY12, but eventually it was postponed to Q1, and then again it was postponed to Q2 of FY13. So this was very crucial for their sensitive CSM contracts as well, because global innovators were a part of it. So any further delay could have impacted their credibility as well. But I think in FY14, they finally began operations with this plant. So another target, then they have missed a few guidelines. That is 18 to 20% revenue growth for FY18, which they missed. And then there's 21% EBITDA margins growth in FY19. It stood at 20%. And then FY20, they missed another guideline. They expected to do 25% plus revenue growth for FY20, but their year-on-year growth was at 18.5% for FY20. Now, moving on to the management integrity and risk checks, I request Rishabh to take over from here.
Thank you, Shantanu, for your lovely presentation. Now I will be taking it from here. My prime focus will be on management integrity and forensic. I will be trying to answer a number of questions, and by doing so, I expect that I will be able to give a good idea about my topic. So let's begin. Our first question is, has the management delivered a good ROE to shareholders historically? It will not be totally accurate on our part to comment whether the management of PI industry has been able to deliver a good ROE to shareholder over a long period of time by only looking at ROE. We need to compare the ROE with some yardstick. We take the cost of equity as this yardstick. We have calculated cost of equity using the capital asset pricing model. As you can see in the graph below, we have calculated cost of equity in three scenarios. The difference among this cost of equity arises because of different expected market return which we have taken. In first case, we have used 10-year CAGR of Sensex as expected market return. Then in the second case, we have used 5 years CAGR of Sensex. And in the third and final case, we have taken the average of last 10 years and 5 years CAGR of Sensex. As you can see in the above diagram, for the last 10 years, ROE has been far greater than its cost of equity for any scenario. But from 2017-18 onwards, the ROE started to come down significantly, and this downward trend is continuing. The company's ROE took another hit when the company raised 2,000 crore from QIP, which led to an increase in its equity base. And now, for the first time in 10 years, there is no margin between ROE and cost of equity. Now, moving to the next question. Is excess cash generated by management to shareholder in form of dividend and share buyback? Let us first look at the net cash flow of PI industry for last 10 years. We found out that the net cash flow are not that large. Now, let us look at the dividend for last 10 years. The company has been paying dividend for the last 10 years. If the company did not pay dividend, it could have increased its net cash flow by a considerable level. But the company decided to pay those cash to shareholder, which is a good sign. Now let's look at cash position of PI. We find that the company maintained very low cash prior to 2002. From 2021, company cash increased by 10 times in 2021 in comparison to 2020 because of QIP of 2000 crore. The company wants to diversify its business. It is trying to go in pharma sector and has also ambition of moving into non-agrochemical space. Company cannot be expected to pay dividend on this cash. So by analyzing all the data point, we find that even in the past, when the company had very little net cash flow, the company still paid dividend. Therefore, we conclude that the management has given excess cash to the shareholder in form of dividend, and by the way, there was no buyback of share in the last 10 years. Now, let's moving to the next question. Is the management transparent? Now, in order to answer this question first, we need to understand what do we mean by uh, a transparent management. Now, let me give my definition of what I consider a transparent management. Transparent management is not one that provides only financial statement, which it is bound to provide by law, but goes a step beyond and provides various other metrics, even though not bounded by the law, but which shows various aspects of business and stick to them, even if the business is going through choppy waters. The management not only give detailed layout of their future plan, but very clearly mention about the risks. The investor does not have to think about possible risks, but it is explicitly stated by the management. And other important characteristic of management is that they are very concise and straight to the point. There is no beating around the bush. So now let us come to PI industry. The thing which strike me the most in case of PI industry was its refusal to share product-wise revenue data regarding both its domestic and export product. The company considered this as a trade secret, but I don't know how sharing data regarding product-wise revenue distribution can be a trade secret. It may be difficult for you and me to have an idea of various product revenue, but just think, if you are a competitor, you have of PI, you have a distribution network, you have people on the ground, you can talk to customer, and it is not that tough for you if you are a competitor of PI, to get an idea of PI market share. I didn't find any reason for PI for not disclosing such data. Now let's move to the next question, which is there a key man risk? So let us first understand what is a key man risk in a business. A key man in a business can be the promoter or any other key managerial person who was instrumental in bringing the company where it is today. PI industry is a promoter driven business where the majority of the stake is controlled by promoter family. The business model per se is not that complex. One of the most important thing in this business is to build trust with its global innovator partners. PI was a pioneer in this field. It has for many years maintained extremely good relationship with its client, as this fact is presented by the now managing director Mayak Singhal, that the company has never lost a single client in its history. So, till we have the promoter intact, we can say the company will maintain its present course of keeping extremely good relationship with its client by ensuring their IP protection. Ensuring IP protection is quite easy, that doesn't need much managerial prowess, but a very honest and strong character, as the promoter have demonstrated themselves. The company needs mostly to leverage on this reputation and obtain more and more business. Of course, there are other components, but it is the most important component, as this trust differentiate PI from its competitor. At present, the promoter family has close to 50% stake. Till the promoter is there, we can expect that PI will continue its business with complete honesty and integrity. Thus, as long as the promoter's stake is intact, we can say there is no key man risk. Now, let's move to the next question. Is this a promoter-driven company? Yes, it is a promoter-driven company. Now, let us look into the shareholding pattern of the company. We will find that Mayank Singhal, the present MD, has the highest stake, followed by his mother, Madhu Singhal, father, Talir Singhal, and his two sisters, Pooja Singhal and Sefali Kushlani. His two sisters, Singhal and Sefali Kushlani, have negligible shareholding, and both of them are not actively engaged with the company in any manner. The promoter family has a 46% stake. As Mayank Singhal is the MD and his other siblings have not joined the company, we can quite safely conclude that Mayank Singhal will continue to lead the company in future. Now, let's move to the con calls. Now, I studied the last 3 years con call, and these are some important facts which I found out. As I earlier mentioned, the company did not give any product-wise data of their domestic business or the export. Then the overall market size, according to PI, is something around 6 to 8 billion US dollar. The managing director Mayank Singhal has proudly stated that PI has never lost a single customer. And the last point, as my friend Shantanu clearly mentioned also, that the company is very much reliant on producing more and more better products every year. They are majority of the sale they have given a rough idea comes from the most recent product which they supply in the market. So from here, the next part, Surinder will take over. Oh, sorry, I forgot. I'm sorry. Extremely sorry. Okay. Now we have evaluated PI industry on 23 forensic parameter, and we can say that it has performed quite well. It has out of 23, it has passed 19 parameters, and in 4 it is not able to pass. So let me go through the parameters in which PI was not able to pass the test. The first was the promoter skin in the game. Although the promoter ownership is less than 50%, but it is very close to 50%. It is something like 46%. But one thing we can be assured, that majority of the family's net worth is invested in the company. So in case we can say that although they have quite a lot skin in the game, although they don't, it was ideal that if they had more than 50% stake, it would have been better. Now, looking at the auditor quality, the company has 7 subsidiary companies, and out of which their foreign subsidiary PI Japan is unaudited. When asked about this, the management said that it is not mandatory by the laws in Japan to have such a small company audited. So this is the reason they did not audit their that subsidiary. Now, related party transactions, the company pays 20 lakh rent to one of the former KMP. It is Salil Singhal, the father of Mayank Singhal, and who was the former managing director. Although this is, you can say a red flag, but the amount is quite insignificant in comparison to the total revenue earnings it earned. But the fourth point is quite significant, that the company has purchased service amounting to rupees 1.4 crore for the relatives of KMP, and the most problematic aspect of this is that the company has not provided any further clarification about it. I have read the latest con call, but there is also nothing mentioned about it, and and we are trying to dig in more about this part. And from this, I conclude my part, and now I give it over to Surinder.
Thank you, Rishabh. Now I would like to continue the presentation in business quality checks point. By this time, you might have got the overview of the what business the PI industry is into, but we'll quickly go through it, and we'll discuss a lot on growth triggers and their supply chain dynamics. Initially, the PI industries is one of the leading agri-science business, and it has a unique business model of providing innovative farm solutions to the farmers. Next. And it has also partnered with global innovator companies like Bayer's, Syngenta, and BASF, and they provide CSM services, which we had already discussed. And it is also into the marketing and distribution of their products. If you see their portfolio of their chemicals, it products includes insecticides, fungicides, and herbicides. And also recently, in the last financial year 2021-2022, they have launched 13 specialized brands in their horticulture segment. And it is like in fungicide segment 6, and insecticide segment 5, and herbicide segment 2 products. And it is also the one of the biggest producer of generic molecules like profenophos, ethion, and phorate in India. Coming to their presence in globally, company has its presence in 30 plus countries. It has its physical presence in India, Japan, China, and Germany, and while it exports to USA, Brazil, and some other countries. In CSM business, what they do is initially they develop the product and scale up it and manufactures, and it exports to the companies. And most of their revenue comes from their exports, which is nearly about 70% of their revenues. And if we see their data, the growth in exports is more when compared with the growth in domestic segment. In Q3 FY23, there is 30% growth in exports, whereas in domestic segment, the growth is limited to 15%. Domestically, they have 30% of their revenues, and most of their revenues are from the products which consists of their insecticides and fungicides. And mainly, they have some major brands like Nominee Gold and Ocean, BOTR, Costco, Rocket, Kifun, Elite, and Humisol. They have strong brand built among the farmers, and it has tremendous brand recognition which is built over the years. It also has their marketing and distribution services and R&D services. In marketing and distribution services, they have before their distribution services, they do their research on geographical potential and product pre and post launch activities and campaign, and product stewardship, crop diversification, and development. They also carry out evaluation and trials. In their R&D services, they carry out the first target discovery and molecule design, and the library synthesis, biological evolution, and root synthesis. They have very vast R&D services. Recently, they have set up a CRO and CDMO plant, research plant in Hyderabad. Coming to the growth triggers, if you see the economic triggers, globally, the chemical sector is poised to grow at 4.7 CAGR. And with the accelerated adoption of China Plus One strategy, most of the Indian chemical companies and specialty chemicals and agrochemicals are expected to benefit from these factors. Coming to the company-specific triggers, the company has more focus on target crop protection chemicals based on cotton, the crops which are hugely grown in India and subcontinent, like cotton, rice, chili, and wheat, and some other products. So they are mainly focusing on products related to these crops. We have discussed that they have good R&D setup, which it has a trigger for their growth, where they have 500 plus scientists and 130 plus patents filed, and are also continuously some new products launching every year. And it has also a kilo lab and pilot plant where they can do their trials. It is a mimic plant to ensure that the desired form of polymorph and APIs are obtained can be trialed in their own plant. And if you see their total R&D expenditure as a percentage of their revenue, it is around 2.71% in 21 and 22. And in CapEx point of view, in CapEx point of view, they have spent 600 crores in financial year 23, out of which some of these are utilized for their ongoing plants and their designs. And as Bhavana said, that 67.5 crores is invested in the PA Health Science to kickstart their initiatives on pharma. Here, there is one interesting point which happened recently. As Bhavana said, that they have around 2,000 crores of QIP sitting idle in their balance sheet. Many of the investors are worried about that. But on April 28th, 2023, like just 10 days back, they have announced that they have some acquisitions in pharma space, because they are looking for these entering into the pharma space, and they are sitting with the cash for almost about 3 years. So they finally came up with their announcement, and they have acquired some Terrachem Research Medilab, TRM, and Archimica company. It is Italy-based company, and they have acquired these two companies under PI Health Science, which is wholly owned subsidiary of PI Industries, out of which they spend 50 millions for Terrachem Research Medilab acquisition and 34.3 millions for Archimica acquisition. These data I found just recently, so it's not possible to include in the presentation. But I added all the data in Notion under growth triggers. So they are saying that these acquisitions come into effect immediately, and they are effectively utilizing these capacities. So they are expecting their revenues to go up in the coming quarters. And they are also added these research facilities of these two acquisitions. We combine with the R&D capabilities in the new integrated pharma research center in Hyderabad. So this is one point where we need to look at in terms of growth triggers. And they are also guiding 20% of their contribution from non-agri chemicals in coming 4 to 5 years. Right now, they don't have any of their revenues from non-agri chemical products, but in the point of diversifying themselves, they are working on some electrochemicals, and they are also guiding to intensify their capex somewhere between 800 to 850 crores in FY24. Next. So if we look at their margins and metrics, when we compare the gross margins with the revenues from the last 6 years, from FY17 to FY22, they are able to effectively maintain the gross margins at an average of 40.83. And before it was quite less, between 32 to 40% in from FY13 to FY16. Actually, when coming to the business point of view, Shantanu said that from FY13-14, that is the exact period where they started expanding aggressively and into the CSM business. And also in FY19, they acquired ISGRO Asian company for their domestic product expansion. So going ahead, margins are quite around 40%. Next. So if we see their gross margin to EBITDA conversion, almost 50% of their gross margins are converted into EBITDA. We see in FY17 it is 55%, 51, 54, and 57. And in the recent year, it was 54%. Next. So ROE and ROC point of view, as we already discussed, like from the last couple of years, their QOPs are sitting idle, so it is affecting their ROE and ROC metrics. And if we compare the ROC and ROE with the WACC and cost of equity, they are well ahead of ROC is well ahead of WACC. Their ROCs are at 17% and WACC is at 11%. And ROE is at 13.8% and cost of equity is around 20, somewhere around 21%. So ROC and ROE are well ahead of WACC and COE. Next. Coming to the supply chain dynamics, they are mainly into research, manufacturing, and contract development and formulations. And they remain raw materials are some of the raw materials influence some of the commodity prices and chemical molecules like methyl isocyanate and methyl chloride. And also there are some of their raw materials which I had attached in the notion with their some chemical proportions, and typically they enter into the long-term contracts to source their key raw materials from approved suppliers, and also they source the raw materials through quarterly and monthly contracts and procure them from open market depending on the market conditions. And if we see over the years, so they have continued to diversify their procurement base, and they are able to reduce their amount of materials that they source from China. And in the con calls, in recent Q3 con call, one of the person asked, like even the increasing scenario of their raw material prices, how they are able to maintain their gross margins. The management is saying that they are working on a model where the transparency of the raw material costs in the past 1 to 1.5 years, there is significant increase in the input cost, but they are able to maintain because of their improved product mix, and have commercialized more than 10 to 12 products in the last 2.5 years. And also, secondly, they are stating that their operating leverage benefit is also kicking in for them. And few years back, their capacities were underutilized, but now they are able to utilize their most of their capacities. So the reason they are able to maintain their margins even though the raw material prices are fluctuating. Next. I had attached the detailed con call in the notion. And if we see their concentration on risk and threats, most of their revenues are from CSM business segment, where most of their clients are from the Europe and US based, and only 23% of their revenues are from domestic segment. Next. So there is a chance that their partners, innovative partner companies, withdraw at any time. But generally, in this field, the long-term contracts will be having a lot of trust in them. And in geographically, if we see, most of their revenues are from US, which is around 35%, and from Europe it is 8%. So both US and EU contribute around 43% of their revenues, where the forex risk plays in, and US is being their major contributor, which makes a dependency on only one country is also considered as a threat. And this geographical split data I had got it from 2020. So with this, I would like to conclude my part, and I would like to hand over it to Shantanu.
Thank you, Surendra. We'll quickly go through the threat of substitution, and we'll mainly focus on the domestic agri-input side. So, yeah, due to the time constraint, I'll kind of go a little fast. But three major products that they have for their domestic agri-input side includes nominee gold, which the composition of it includes bispiritac sodium, and it is a herbicide that, when planted with the seed, protects the plant from weeds. And there's Ocean, which is dinotefuran. Basically, it is an insecticide which is used for managing brown plant hoppers. They are like they look like cockroaches, but then they eat up cotton paddy crops. So, and there's also Biovita, which is Ascophyllum nodosum. It is a PGR, plant growth regulator. It is entirely seaweed based, and it provides naturally occurring balanced nutrition to the crop. So we'll only focus on the first two, because that's what I could get major data on. The other three, so what their pattern has been is their top 5 products that contribute to their top line growth in the domestic business, say. So these two, Nominee and Ocean, for the past 8 years, they have consistently been the top 2 in providing the top line growth for the domestic business. And the third, fourth, fifth position keep changing. Now, suppose there's Biovita. Then they have also called something product called Aukira, which is a herbicide. And sometimes, the places, basically, the positions keep shifting. So we'll focus on the first two. So firstly, we have nominee gold, which is bispiritac sodium. It is a broad spectrum herbicide, which is basically used in rice production, in direct sown rice, rice nursery, and transplanted rice, etc. So it controls major grasses, sedges, and broad leaf weeds of rice. So everything related to rice. So what it does, it minimizes yield losses by weed infestation. So nominee gold has translated into savings of nearly rupees 5,000 per hectare. So so here's the prices of like different companies that have similar product, as in the ones which include bispiritac sodium. But I mean, you can't really conclude anything from these prices, but it is the latest price data. And with this, I'll be explaining a certain points through which we can kind of create a picture. So you can't make a conclusive statement because we don't have historical prices or anything. But if we see nominee gold, it enables farmers to basically sow rice with less water, which improves their yield. And secondly, PI, like we said, they have a strong connect with the farmers. They focus on involving and educating farmers. So they have exhibitions, they have seminars, and in which they involve lakhs of farmers, and that's how they kind of place their product, and they do a lot of marketing. Next, we have since nominee gold went off patent in FY18, there have been efforts on the company to protect their margins. They have been doing price cuts and domestic manufacturing. Domestic manufacturing, they actually started to, in 2017, they started to manufacture and distribute bispiritac sodium nominee gold of Qumai chemicals in India to achieve operational efficiencies and further growth. So PI had 50% share in this, and QMI Chemical had 50%. So it was a JV basically. And next, so they began domestic production in FY20. This gave them more flexibility and more ways to increase their revenue basically from nominee growth. So they have not only successfully defended the challenges from generics and other competitors, but also they posted the highest ever treated acreages in FY19. And they achieved the highest ever sales of nominee, 500 kiloliter in FY20. And at that time, their market share, they held a dominant position with 70% market share, which they have kind of maintained. I don't have the numbers because they don't give data as such. But if you kind of try and estimate from their com calls, they have maintained this dominant position in the market. And yet, nominee gold is the top contributor to their top line growth in the domestic domestic agri-inputs business. So, yeah, other than that, yeah, they maintain the dominant position in the market. So, Oshin dinotefuran, Oshin is basically a novel insecticide which was invented in Japan by Mitsui Chemicals. In India, PI registered it and developed Oshin in collaboration with Mitsui after the research of more than 6 years. So Oshin, what it does is it effectively kills the rice hoppers, matlab brown plant hoppers, which is the most damaging pest for a rice crop. So BPH, if not, and also cotton crops. BPH, if not if they are not controlled timely, they can yield losses to farmers. So this was supposed to help Indian farmers to protect their rice and cotton crops and increase their crop yield, basically. So again, I've also given comparative prices here, but let's not go into that. So again, it's a systematic insecticide, and it can so this BPH can result in 100% losses for farmers, and Oshin basically prevents it. So effectiveness of this chemical called dinotefuran, right? So it is compared to any other insecticide that works against BPH, it does the best job. It starts action within 24 hours of spraying, and it also provides long duration control. And during rains also it can be sprayed, which was one of the key advantages when it was launched. And one more advantage that PI has in terms of Oshin is that they have a great cross-selling opportunity because they have a great network with farmers. And firstly, they are selling nominee. So that market is already available to them. And this allows them to access a market for Oshin as well. That is why Oshin has been the second most contributing product to their top line growth since FY13. So in 2018, again, Oshin also went generic and they saw significant competition. So, but what they have to say and what if you read and whatever content I've consumed, I can say that what they do is mainly in their domestic business, there are 5 to 6 brands that would contribute to most of the sale. And what happens is every 2 years, say, they launch a new product serving a different purpose, and they do a lot of marketing and lot of networking with the farmers, etc. And what they've been doing is in the next 3 to 4 years after the launch of that product, they kind of manage to include that in their top 5 to 6 brands that contribute to their top line growth. So this is how the things have been changing, except for Nominee and Oshin, which have consistently been the top 2. So that's how they kind of safeguard them against certain products going generic. Yeah, and lastly, the demand for Oshin still continues to increase, and so we can kind of conclude that they've been able to protect their margins. They have done price cuts, and then also they did things like domestic production. So they have been successful in kind of protecting their dominant position in these 2 products in the overall market. Next, next I'd like Bhavna to take over.
Thank you, Shantanu. So going into the CRAMS, CDMO and CMO check and focusing on the R&D of PNI, In FY 2022, the R&D team analyzed 48 projects and they selected nearly 20 molecules for further development. And 10 projects successfully reached commercialization, while 9 projects underwent process improvements to increase the efficiency and reduce costs at the plant level. The company has also commissioned a pharma lab in Udaipur that is working on technology scale-up of novel catalysts and green chemistry. So this world-class R&D facility at Udaipur has nearly 350 plus scientists and researchers, along with advanced research and developmental labs. The company also has a state-of-the-art R&D facility for crop protection with various labs, greenhouse facilities, and farm resources. So this facility supports R&D projects related to plant diseases, animal pests, weed control, and it includes chemical synthesis, analytics, etc. As of FY 2022, PI crossed the milestone of having filed more than 130 patents. And one major landmark achievement with respect to R&D in PI's history was the Sony R&D Center that was formed for carrying out research in the area of synthetic organic chemicals for application in the electronics industry. So this laboratory, which is a part of PI's research and development facility at Udaipur, was inaugurated in 2011, and it was the first of its kind where Sony Corporation jointly conducted research in partnership with PI. Nobel-winning scientists are also involved, like Dr. Nekeshi, who won the Nobel Prize in Chemistry. And he visited PI along with Sony's senior vice president, and they jointly inaugurated the research center. So this gives great credibility to the management of PI as well as the company's R&D capability. This high technical capability of Sony, along with the large chemical manufacturing facility of PI, combined has helped develop the synthetic organic chemical in a cost-effective manner. And this will also continue to benefit PI to improve its profitability. And while comparing PI with its peers, I've taken UPL, Rallis, and Dhanuka. UPL is in the lead, which is followed by Rallis and Dhanuka, which is followed by PI and then Rallis and Dhanuka. So PI's R&D expenditure has risen from 838 million to 1,334 million in 4 years. Moving on to the next slide, marketing and distribution. So PI Industries has a very strong marketing network of over 10,000 distributors and more than 1 lakh retailers, and they have a pan-India reach of over 3 million farmers. For the formulations, PI has 2 major formulation units at Panoli Center to cater to domestic requirements of both local as well as global clientele. The company's formulation facilities process agrochemicals in a wide range of chemical processes like WDG, WC, GR, etc. And while comparing PI with its peers with respect to marketing and distribution, Rallis has the highest expenditure, which is followed by Dhanuka, PI, and then UPL. PI's expenditure on marketing and distribution has increased from 1.98% to 2.5% from FY21 to FY22. And speaking about some of the moats that PI Industries has, first of all, PI is a company that is engaged in 2 very high potential business segments, CSM and Agri-Inputs, and it derives its strength from its strong association with leading global innovator companies to whom it offers a unique no-conflict business model with utmost respect to IPs. So the success of this model is evident from the fact that 95% of PI's CSM business comes from patented molecules, and that too in an early part of their life cycle. So such an early stage association with global innovator companies makes PI their partner rather than a supplier, and it de-risks their business to a great extent. Another aspect which makes the business model of PI in the CSM space a relatively safe and de-risked one is that to most of its customers in the CSM space, PI is either the only or the one of the only 2 suppliers. And the only risk that remains with the PI is the delivery risk, which is taken care of by the professional and efficient management at the top. The second point is that in the Agri-Input business too, PI adopts a very unique business model, quite distinct from its peers. It derives this model from its other segment, CSM, from where it draws global innovator companies' molecules to the to the CSM space, and then, if the management feels that such innovative molecules also have a market potential in India, it enters into an in-licensing agreement with the innovator company, which not only enhances the trust of the customer, but it gives the PI privileged status in the customer's business strategy. So, the success of this model is evident from the performance of their flagship brand, Nomini Gold, which Shantanu spoke about. It is a rice herbicide which was brought to India by PI via in-licensing arrangement with Japan's Kumiai Chemical. And they also have a very strong distribution network which is spread across 1,500 plus distributors and a pan-India reach of more than 25,000 plus retailers. The third point, the business model which PI has adopted focuses on patented products, and it takes a great amount of time to establish trust and to prove R&D capability. So once these things are done, scale up is very fast, and in India there is no other company following this kind of focus on patented products, and that too in such an early stage in their life cycle. So these molecules are very critical to the innovator companies. So they pick their suppliers very carefully after rigorous evaluation, because any delay in the delivery or any flaw can result in significant loss of revenue to the innovator company. So it was the effort of PI since many years that has resulted in a swell in their order book. Moving on to the final point, other companies in India normally focus only on off-patent products. The few who focus on patented products like Divi's have a slightly different operating landscape and model than PI. And to add further, the focus on patented molecules is a time-consuming process, and the scale-up here is much slower in the initial stage. So companies in India will generally not attempt to do so. So as far as the competition goes, there is no domestic competition for PI, and the current order book is established by PI by winning orders against many global majors in the CSM space like Lonza, DSM, and Salty. So handing over next to Rishabh, he'll speak on the valuations.
Yeah, Rishabh, could you please share your
Thanks.
screen? Yeah.
Yeah, I'm sharing. Is it visible now? Hello?
Yeah, it's visible.
Yes.
Okay. Now, this is my PLN assumption sheet. So, in order to build a financial model, there are basically three main cases: bull case, base case, and bear case. But in case of PI, as the management has said time and again that it has a certain revenue expectation. So, I have also included another case, that there is the management case. Now, let me go through all the line items. The first line item is sales. Now, as you can see, the sales 2014, the sales was 39%, and after that, the for the last 8 years, there has been only one instance in which the company has been able to generate sale greater than 30%. And in from 2016 to 18, there was a period of very low growth. So by taking this, I infer some of the assumptions. Like let me start. The case one, which is the management case, I took 20% because the management has said that the management expects to increase revenue by 20%. So this is the first case. For the bull case, I have take revenue. I have considered that the revenue will grow by 25% because as you see, revenue growth of more than 30% was the business was not able to sustain it for more than 1 year. Now, and for the bear case, I have taken that 8, 9. I have taken a single digit number. As you can see, during 2016 to 18, for this 3 year period, PI didn't perform much well, and I have taken a base case which I have find out by taking something middle between the bull and the bear case. Now the expenses you can see are quite consistent. The highest goes for 84%, and the lowest was 76% of total sales. So for the management case and the bull case, I have taken 75 and 75%, and for the base case, I 80%, and for a pessimistic case, I have taken 85%. Now operating profit is self-explanatory. I don't have to say anything about it. Other income, for the I have not projected any other income because there is a reason towards it. The business should earn revenue from its operation. Other income, I think, should not be included in the. It would be better if you don't include the other income. And you can see the other income is extremely. It it doesn't have a central tendency. In 2014, it grew by 42%, then 208%, then it didn't grow much, then suddenly there was another jump. So I have not taken any projection for other income. Depreciation and interest are self-explanatory. Profit after tax and tax rate are also explanatory. As you can see, at present, the management case I have selected in the selected case. Now, if I take bull case, you can see the number changes. Similarly, for the base case, you can see all the line items are changing, and similarly for the bear case, all the line items are changing. Now, I have linked this sheet with the PLN sheet. This is the historical, and the red portion is the what I expect in the future. Now, this number will vary depending on what type of case you take. Suppose I take a bull case. Now,
Rishabh, let's run through the base case, not the bull case, if you don't mind.
Okay, sir. We are going to the base case. Now, it has changed, and here there is nothing much to explain. And now I move to the most important part, that is valuation. Now, I have done a forward-looking valuation for the next 5 years. I have taken majorly 3 main ratios: the price to earning ratio, the price to sales ratio, and EB by EBITDA ratio. Now, so let's start. Let's start with PE ratio first. This is the historical trend in which the EPS has grown of PI industry for 2013 to 2022, and this is the trend in which the PE PE of PI industry has grown during that period. Now, if you look at this, the PE of PE industry has been growing at a constant rate. It is sometimes it makes a it becomes flat for 2 years, then it again rises. It becomes little flat, but you can say overall the trend is quite bullish. If I find out the median PE for PE, median PE for PI was 33. Now you can say that the company is now on high valuation. Company has never achieved this PE in its existence. So now the problem lies. EPS we can find out. It's quite easy to find out by using financial model. You have 4 cases, and this gives your PE, your EPS. Sorry, but PE is quite difficult. Now, 3 cases can occur. First case is the PE rates, that is the PE ratio increase. The second case is the PE derates, that the PE ratio doesn't rise. Or the third case, the PE remains the same. I have assumed the PE, if it derates, it may increase by 10%, or if it derates, it will decrease by 5%, or it will remain the same. There can be infinite possibilities in this. So, sir, which scenario would you like to choose?
This is your assumption now going ahead. I just wanted to see the base case valuation. Now, whatever you
Okay,
think
sir.
will happen in the business,
Okay.
you can take us through.
Okay. No, so let us take the bull case. It is the PE rates. Now, as you can see, I have assumed that the PE will increase by 10% every year. So if the PE here the PE is increasing by 10% every year, and now by multiplying the PE by EPS, we get the current market price. Now by now looking at where we are, an investor can think about his investment time horizon. If an investor in 2023 wants to have a time horizon for say 2026, he will find that the company is undervalued, so he can buy it. Or if now it is upon him what time horizon he choose. Now let's move to the PS ratio, that is the price to sales ratio. For the price to sales ratio, I have taken the sales and same the forecast is 1 2. The number of shares, these are in actually crores, and I have calculated sales per share, that is sales divided by number of shares. It is the current market price, and this is linked with actually that like if you change it, suppose let me take PAD rates. Now see, it has changed. The number has quite significantly changed. And now this is the PE ratio. No, it is a PS ratio, the price to sales ratio. Now similarly, the investor is quite independent to which assumption he took. And finally, I will be talking about the EB by EBITDA ratio. For EB by EBITDA, we know EB is market capitalization plus net debt. So here I have taken the market capitalization. Here I have taken the net debt. Adding this, I get the adding both these two, I get the EV, and EBITDA, which is the operating profit, which I already have from the PLN assumption sheet, or the sorry for the from the profit and loss sheet, and this is the EV by EBITDA range, and you can see in the bear case it is quite falling now. So this is my valuation sheet, and with this I conclude my we conclude our presentation.
Rishabh,
Thank you,
is there?
everyone.
Yeah, thanks, guys. Before you guys finish, so I have a question. So this is the model. So like people can change, but as a team, have you guys formed a view on what the fair value is using the model?
The valuation part was done by me only. Alone.
Yeah. So as it, I mean, okay, then in that case, have you formed a view of what the fair value is for this company based on your model?
Actually, I like
Yes or no,
companies
because we
like
have already spent
no.
1.5 hours. If it's no, then we'll discuss tomorrow.
No.
Okay, cool. Thanks.
So sir, I am stop sharing my screen. Huh?
Yeah. Thank you, guys. I mean, this was
And
extremely
apologies for
detailed.
time.
Yeah. I mean, anything above 1 hour, guys, attention becomes very tough to. It becomes very tough to hold people's attention. So keep that in mind maybe next time. But I enjoyed the presentation because I was loving all the details. But a general audience may start losing concentration after say 45 minutes or 1 hour. Yeah. So especially I made some notes. Some of the things that I really liked was your walk the talk check was really good, Shantanu. I think that is something. See, for PI Industries or Sharda Cropchem, these are well-known companies, and people already know what kind of management they have, right? But this kind of walk the talk check, if you do it for a company, a smaller company, right, by looking at what their guidance has been versus what they've delivered, it can give us a very good view on how much to trust the management.
Yes.
So that was, I think, really well done. And overall, only one thing I would say, team, is that I know you guys have followed the flow from the document. I think when you're presenting a PPT, it's better to present it in the story format that you think will convey the story best. In my case, I could relate to the story in the way you presented because I was aware of what more or less on AgChem and PI industries a little bit. But I think it will be better if you can, I think, present it from, say, the business model at the start and starting with the products and then going into, the every other aspect. So
Yes.
treat that checklist as a checklist, and you can determine your own flow. So the flow of the presentation should be determined by how logical storytelling should go. About when explaining a company. So don't feel constrained by the flow of the document. Yeah. In this case, you guys ticked all the boxes. So I mean, I liked it, but I can understand that some other person who's not familiar with our maybe our document, or somebody who's not familiar with this industry as such would first want to know, okay, ये company करती क्या है, right? Before we are trying to understand कि capex कैसा किया, या how the company did some other things before. So that is one minor feedback. But overall, I mean, a lot of work has gone in, and this is exactly what we wanted you guys to do with Sharda Cropchem and with PI Industries. That how to work as a team. If you have to produce a research report quality work, what is the structural approach that you guys should take? Yeah. So you guys, Shantanu's team, I must congratulate you guys for taking the spirit of the task very seriously, and actually, doing all the tasks, in that fashion. So that structure will help you guys going forward. When you analyze a company, I think now that document should become a part of your, part of your ethos in terms of analysis. You don't need to explicitly structure the PPT according to that, or explicitly even cover everything, but you will know that those checks internally, without those checks, you will not be able to do the PPT, or wherever there is a gap, you will know that there is a gap, and in the PPT you can call that out, right? So that was the intention, and I think that has been served beautifully. So, Rishabh, Shantanu, Bhavna, Surendra, congrats on a great presentation. Even though it was long, I really enjoyed it. Thank you.
Thank you.
Yeah, I have similar feedback actually. I don't know whether my voice is echoing right now, so I'm in a different place and with different mic. But in general, your presentation was really nice, and I thoroughly enjoyed it. I don't have many feedback, but maybe I'll add it in the uh, feedback sheet if there's something I need to understand. One help that I would need from all of you is once I upload this in YouTube, if someone of you could just tag it based on the time stamp, right? Because I will use this presentation as a benchmark to hire the next sort of people. So when I ask somebody to evaluate the management quality as a part of the onboarding activity or filtering process, I will probably use this. Yeah, but I'm superbly impressed by how all 6 of you have turned up. I mean, yesterday's presentation was also very nice. It was very informative and crisp, and today was very detailed. But I mean, you that's one of the reason why we went with PI industry, because we wanted to see how the business, where lots of information, lots of value picker content is there, how that turns up, so that for the next undiscovered story that we are trying to look there, we can use these kind of similar structure to kind of think. Yeah.
Yes.
So overall, great. Yeah, I mean, all 6 of you must congratulate yourself. And also, I think today this is Bhavna's last presentation. So thank you, Bhavna, for the entire journey. I think you as a person, have seen you grown from, I mean, how you started out to what you're able to do right now. So once you are done with your exams and all, I mean, if you don't have any other gig, just join us again.
Yeah, sure. Thank you so much. Even I learned lots.
Yeah,
I had
thank you,
that's
no
great.
Bhavna.
idea
Yeah.
about equity research in the beginning, and now I have a parent.
Yes. I think Nirvan also did, I mean, a great job by sort of training. I never expected this sort of maturity would come in a span of 4 months, right? So
Yeah, thanks,
that's
Bhavna. It
really
was
good.
lovely working with you. Hope
Thank you
to,
so much. It
Yeah,
was great working with you all too.
yeah, thanks, and hope
awesome.
to interact with you again. Bye. Take care.
Same
Yes,
here. Thank you.
Yeah,
awesome.
All the best,
So the
Bhavna, for
next
your
thing,
yeah.
Thank you. Thank you. You too, Surendra.
Gaurav,
right?
before we move
Hmm.
on to the next task, can I quickly just say one thing to Team Shantanu? So,
Yeah, please.
Rishabh has spent a lot of time on that valuation model, guys.
Yeah.
I would love it if 4 of you, or if Bhavna is able to join, great. Even if she's not able to, at least the 3 of you, please get together and select sort of. Now, you guys have analyzed the business. You know the triggers. you know where management is going, all of you know these things, right? So using the model which has been built, try to select the bear, bull, whatever scenario you think is likely to play out. Try to select the revenue growth, the expense, the whatever parameters are there, and try to give us a range, a valuation range, which you think is fair value for the company using a valuation metric. Okay, I think that will beautifully round up the real hard work that you guys have done, and this will become like a model analysis. Yeah.
Yes,
So
that's
Yeah.
just spend some more time together. The model is already there. You guys need to use the knowledge gained to sort of nail down, okay, इतना revenue growth होगा, इतना expense होगा, ये parameter इतने अच्छे से नहीं बढ़ेगा, इसको P अभी derate होगा थोड़ा, या P और strengthen होगा. So just do that and give us a valuation range.
Sir,
to
how was the
complete.
model?
I will comment on the model. Let's comment on the model, Rishabh, when we see the final output. I think the model was quite nice in the sense that there are different parameters you can bring in. I think in terms of costs, one feedback, Rishabh, I don't want you guys to again redo the work. You can do it parallelly later, Rishabh. But cost को ना एक block की तरह model अगर ना करो तो better है. If you can model gross margins or like COGS separately and then some operating costs separately,
Okay, sir.
that might make
Like another sheet.
yeah, that might make it more
Okay,
accurate.
sir.
Like अभी तुम क्या कर रहे हो कि पूरे expenses को 75-80% पे
Yeah.
subtract करके direct तुम EBITDA या PBT पे आ रहे हो, तो उसको अगर तुम gross margin और operating cost ये दोनों चीजों में divide करो, so I think you will be able to project more accurately. Okay, that's the only. Yeah.
I think Nirvan.
Yeah.
Yeah. Rishabh, please say. Then I'll add.
Actually, sir, I most enjoyed like making the valuation model. Like it was a lot of learning for me. I think this was the part I enjoyed the most, creating that model, sir.
Great. So I think then we should spend more time and also, for the others to sort of go through the model, and that will be also nice. So that is why I want you guys to come up with, a fair valuation, so that will also give us a chance to go through the model itself. Yeah. And later on, of course, once the model is uploaded on Notion, all of us can go through it. Yeah. And give our feedback on how to improve it, what is good, what can be improved. Yeah. Yeah, Gaurav.
So my question was regarding the Sharda Cropchem model. Who did that? Astha, you did it, right? Or both Astha, you and Mayank? Hello?
Hello, sir. Mayank have helped me regarding the PE
Right.
ratio.
So what I would like all 6 of you to do is, or I mean, Bhavna, if you want to, all 5 of you to do is kind of consistent. I mean, bring down to one sort of a structure which we can use across companies. I mean, we don't want to reinvent every time, right? The structure, and it should look the same. That's number one. Take best practices from each other. The other thing which Nirvan said, that's absolutely right, how you can categorize them. And the third thing is in the model, I mean, if you have some scope for trigger, for example, say a company is bringing out CapEx. Now, if they bring out CapEx, there can be two things. One, the CapEx is fully utilized, say in the first year, or maybe in 2 years or 3 years, and you can have that sort of a model. Versus if the company is unable to use the CapEx, but it has debt going up, right? What would happen in that sort of a scenario? So those scenario analysis, if you can add, because there could be only a few sort of scenario analysis. I mean, every time we encounter one, we can add it to the valuation model and we can sort of model it accordingly, right? What do you think, Nirvan? Would it be too complicated if we take that approach?
It's good. It's great. I think, Gaurav. See, I only one thing on top of that. I think that is exactly the way to go ahead with it. But only thing I would say is when we are analyzing a real opportunity, for example, say right now Punjab Chemicals, okay, that is a real opportunity in the market. I think there doing this kind of exercise would be really valuable versus say a company where we don't see exciting triggers going on. So I would say that next time, of course, we'll be again starting off with a new round of companies. So let's, I think, do it for the most exciting opportunity in the market, because there the hard work that will be put in, that will have a great payoff actually, because this modeling will be not so easy, because you'll have to do you really have to understand what the triggers are and how they can play out. Like they can be two different roads that things can go down. So I think that's the only thing that I would say. Otherwise, yeah, it makes sense for us.
So we keep a platform sort of or we keep one fixed what do you call Excel table, or we make it such that we can add on more and more content to it. We can have sheets which depict that sort of a approach.
Correct. Yeah. So I think we
Right?
can work on sort of getting the model, the base model right, and say modules can be plugged in with a new sheet or something like that, a scenario analysis.
Yeah. Correct. So based on, say, for example, I mean, 2-3 cases. Anytime there's a trigger to a company, there could be 2-3 cases that can work out.
Yeah.
Like your tax increasing, if they take too much debt and they're not able to service those debt. So those sort of a thing, right? Yeah.
Yeah, and
Cool
that will
then.
be
I
case
think-
to
I think-
case. So I mean that will vary from company to company. So we can have the base model ready, and then we can sort of bring in scenarios as needed for that
New and-
particular company. Yeah.
Perfect. I think that will be very, very valuable.
Yeah.
All
For
right.
tomorrow, I think Gaurav, Shantanu's team, if you can give us that flavor of what PI's fair valuation is. Yeah. Maybe spend 1 hour together and just give us that. Don't obsess over the model, etc. But using the model, just try to give us a range. Okay, this is fair value. Yeah. Because I also have a fair value in mind. I want to see how others are seeing. Yeah.
Sir, like L1 value, like which will be the means like intrinsic value type, and another will be the like resistant type. Like if it cross this level, then it will become over value, something like that.
Yeah, basically a fair valuation range. So for example, you can't nail down an exact value. If you think that the most likely scenario, see, for example, I'll give you one example. You said management was guiding for 20% growth. Your bull case is 25% growth, right? So unless there is a history of management under guidance, where management guides very conservatively and they over deliver, I would not even have the 25% as a bull case. Yeah. Because that scenario, if management guides aggressively or accurately, then what is the point of having a scenario which is very low probability of playing out, right? So it depends on your knowledge from having read so much about PI, whether you want to model the 25% scenario at all or not, right? So basically, if you think that how I do it is, say I have 3 scenarios, and after having read the business, I understand that, okay, even if everything is going right, there can be some external variables which can shoot the case, right? So bear case may be unlikely, but I'll still assign a probability to it, say 15-20%. And maybe the base case will have the largest probability, 40-50%, and maybe bull case can have some kind of. So that is the approach that I take, because everything is probabilistic, right? I can't be too sure and nail down one number. So to try to not be overconfident, I do bear, bull, base, and then assign probabilities to these 3 scenarios. Wherein, suppose I am very biased towards the base, I think this is what the number is going to be. I still won't give it 100%. Yeah. Maybe if I'm very, very sure, if the business is very predictable, I will maybe give it 75-80% probability and leave 10% in bear, bull, or maybe if bear is ruled out, then 20% in bull, something like that. Yeah. Otherwise, I will maybe have 50% in base case and 25% or 30-20% in bear, bull. And then I do these valuations separately, and then using the probabilities, I arrive at a weighted average valuation. Yeah. So that is one approach. Yeah. So similarly, I want you guys, because you know all the input is there with you guys कि PI industries में क्या हुआ है और क्या होने वाला है. So use that and the model which is already built to churn out some numbers for us कि bear case में, bull case में, जो भी है, मतलब तुम्हारा final valuation range क्या होगा, yeah? Or maybe one number which is a weighted average number, whatever works for you guys.
Yes, definitely.
Okay, great. Chalo, I
Cool
think,
then.
sorry, Mayank, Astha, today it's very late. So even if you have questions, maybe park it for tomorrow. Hope you guys don't mind. Gaurav, anything else?
No, nothing from my side.